to Business and Wealth Strategy. My name's Karen Newton, and my guest today is Owen O'Malley from the Investment Club Network. Owen, welcome.
Thank you, Karen. Thanks for having me.
Just for some clarity, we will be going back to this topic throughout the conversation, but Owen and I have known each other for 6 years. We have some investment groups together. And you may not be aware, Owen, but I sat down and I worked them all out this morning. And we actually have over 3 million in those investment clubs.
Oh, wow.
So
Excellent.
that's quite an amount. And I know you've got a lot more than just my investment clubs there. So we will come back and talk about that shortly. But I want to go right back to the beginning. And I found out something interesting today that originally you were going to be a salmon farmer. Is that right?
Not going to be, I actually was a salmon farmer for 12 years.
So why shares? What happened?
Yeah, interesting. So I was blessed that the salmon farm I worked for was very progressive back then, and they gave us what's called preferential shares linked to the profitability of the company. And because salmon farming back then, not so much now, it has tight margins now, but back in the early days of salmon farming in Ireland, it wasn't unusual for us to produce the salmon for £3 a kilo and sell it for £5 a kilo and make a nice, healthy 66% margin on it. So much so, we were flirting with the idea of actually floating on the Dublin Stock Exchange. We were a very interesting business that the Dublin Stock Exchange was interested in. But the Norwegians stepped in and bought us out. And once we got bought out and fully owned by the Norwegians, it just became a day job without any preferential shareholding, without any big bonus checks. And so I actively considered the idea of being in business for myself. And I did research what's called the SME organization here in Ireland, which is small to medium enterprises. That's what SME stands for. And I looked at some of their annual reports, and they talked about the fact that 95% of companies fail after 10 years, and that 95% of companies fail to even get to a million turnover. And when they do get to a million turnover, they have modest profit margins of 5%. So I did the maths quickly in my mind, and I said, well, if I'm one of the 5% that's successful, and one of the 5% actually gets to a million turnover, and I make 5% profit, I'm going to clear 50 grand a year. But I'm on a 50 grand salary in the fish farm. So why would I want all that hassle when I'm getting the same amount of money? So I parked the idea of being a business for myself until I came across Tony Robbins.
Mhm.
And in 30 years ago, in 1996, I did his wealth mastery program where he put us in front of 24 of the wealthiest people on the planet, which was a 6 day multi-speaker event. And they distilled their decades of knowledge and experience into days. And they had figured out the stock market is a very powerful vehicle to create a significant amount of wealth. And their message to us was back then is that we all focus on society as in generating income, but we don't focus on creating wealth. And that unless you form an investment club, buy shares, and accumulate shares over time, you will struggle. You'll be part of they give us an interesting statistic that 95% of people at age 60 are either dead or dead broke. So I said, right, I don't want to be part of that. So yeah, I started trade the stock market part time alongside my day job for 2 years. And after 2 years, I was making more money from the stock market by selling options than my actual salary in the fish farm. So I was able to effectively retire, resign from my position at age 36. And people were very curious because they knew I was on a big salary. They knew I had a pension, a company car, and they wanted to know what I was doing. And I said, well, why don't we form an investment club? It was even before the euro came into Ireland. It was back in the days of the punt, which used to be the Irish currency. And I said, let's put 55 punts a month each into a kitty. Let's open up a bank account. Let's open up a trading account, and I'll show you how it all works. And one investment club became 10, became 100, became 1,000. One country became 50 countries. One language became 15 languages. And so we've trained over 25,000 people in the last 30 years to be able to understand how the stock market works and use it as a vehicle to create wealth and generate income as well.
And that's no mean feat either. There's a lot of work involved in doing
There
that.
is. There is.
Yeah. Going back to that, the the club concept works, but you do a bit more than actually just the club because sorry, what I'm trying to say here is that It's not just going and buying the shares. You're not just trading. You're running a hybrid system that is investing and trading. Plus, you're bringing more tools into it to make it more profitable for the people who are in the clubs.
Yes, we are. So majority of people think of the stock market as buy and hold and hope it does well. We take the hope out of it in that we buy and hold, yes, for the long term, but we actively once a month generate income, and we use that income to first target is to own the shares for free, which is not unlike property. Karen, you buy a property, you put in tenants, and your goal is your first goal is to make sure all of the rent accumulated covers the initial investment that you did to buy the property to effectively have a pure positive cash flow business. We do the exact same thing, but we're 10x property because we can get we can get the money back in 1/10 of the time. It's not unusual for us to spend $20 on a share today and 3 years later have $20 back in income. And so we very much focus on being very professional about it, meet once a month, focus on income, generate income, use income to buy more shares, use those new shares to create even more income, use that new income to even create more income. So we start to make income on income, which is classic compound interest.
And that's my favorite because anybody who watches the channel knows I talk compounding interest all the time. And that's because we've got different avenues of money that we're generating within the club. So we are getting the dividend returns. We're also using calls and puts to generate more income and to leverage to get more shares. So we've actually got several ways of generating money within the club. We're not just sat there holding and waiting for a dividend to come in.
Yes. Yeah, and for those people that are listening to the podcast or watching the video, think of your shares as your property. It belongs to you. So, for example, if I buy a share for $9, it's my property. I can electronically interact with Karen, and I can offer those shares for sale at $10 in say 2 months' time. So I bought them for nine, and I tell Karen that she can have them at $10 in 2 months' time. Now, Karen might study that share and might think to herself, wow, a lot could happen in 2 months. That share could go to $12 in 2 months' time. So she does a bit of mental maths and she says, huh, in 2 months' time, I could buy the phone at 10, I could sell it to the market for 12, and I could actually make a $2 profit without actually having to own the shares to do that. And so what she does is she buys an option to own my shares, and she effectively controls my shares for a short 2 month period. And she might give me something like $1 today to be able to take the shares off me or call the shares away from me in 2 months' time at a fixed price of $10. So if it's trading at 12 as she thinks, she can buy it off me for 10, sell it to the market for 12, make $2 profit, and it only cost her $1 to make $2 profit. And so that's why she's motivated to give me income today to promise to do a deal in the future. Now, she's a very smart businesswoman. She will not put all her eggs in one basket and will not put all of her focus on one company. She will look at a range of companies, maybe up to 10 different companies, and she will take out options on all 10 companies. And she knows that mathematically, she only needs one or two to do well, and she can write off any losses on the other seven or eight that don't do well. So that's why she's able to stay in business long term. For me, as an owner of the share, I buy it at nine. I promise it can be sold at 10 in the future or called away from me at 10. So embedded within that deal is a $1 profit. And I get paid $1 today to do that. So if I get paid $1 today on a $9 investment, that's 11% over 2 months. That's 5.5% a month. If indeed the shares do well in 2 months' time, and if indeed they are greater than $10 in the market, Karen will knock on my door and she will call the shares off me at 10, and I make an additional $1 profit. So $1 in the beginning, $1 profit at the end means $2 profit on a $9 investment, which is 22% over 2 months, which is 11% a month per month. So call options is a very powerful strategy to generate an income from what would either up until then would have been an asset that you have to rely on price appreciation. While you're waiting patiently for long-term price appreciation, you can get some short-term income. You can use that income to buy more shares. So next month, I've even got more shares with that income. I can collect even more income, and the more shares I have, the more income I can generate. the more income I generate, the more shares I can buy. So I can create a little compound interest wheel with call options alone. Now, Karen mentioned put options. They're the mirror image of that. So the way a put option works is that I can do my research, look at a company, think it's absolutely brilliant proposition to buy it at $10 today, or I can pause for a moment and tell the market I will commit to buying it at $10 in 2 months' time. The market looks at that and says, whoa, a lot can happen in 2 months. Those shares could go down to $8 in 2 months' time. And someone says, oh, I could buy it at 8. I can force Owen to buy it at 10 because that's what we agreed. And embedded within that proposition is a $2 profit. So for that potential to make 2, they'll give me $1 today. So again, I'm getting $1 up front to promise to buy something that I was happy to buy anyway. And if I do end up getting it put to me at 10, because I got 1 up front, it's effectively only cost me 9. So I get a $1 discount. So it's a way of buying shares at a discounted rate. If you actually understood it, and if you listen to this podcast and you understand put options, you would never buy a share again, meaning you would collect the income first, the put option income first, and secondly, get it put to you at a discount. Now, just to bring it home of something that you may be aware of, Warren Buffett, who we're massive fans of, so much so we've been to 10 of his AGMs in the last 20 years. In 1995, he ended a 7-year program to accumulate 9% of Coca-Cola shares. He owns 400 million shares of Coca-Cola now, which equates to 9% of the company. That last 2% to go from 7% to 9%, he didn't actually buy those shares. He went in, he sold put options. He told the market, I'm happy for you to put those shares to me. He got paid up front. And at his AGM in 1995, and you can go to YouTube and see this, if you find the right section in the 1995 Berkshire Hathaway AGM, he says, sometimes, folks, we get paid up front to buy shares that we want to own. And he told the shareholders at the meeting, we collected $17 million of put premium up front to get another 2% of Coca-Cola put to us. And we were quite happy to take it because we wanted to own it anyway. If he didn't do that strategy, he would have gone in and bought the shares without collecting the 17 million first. So it's a very powerful strategy to be able to generate income. So Karen's very right. We've got shares that we own for the long term. We collect dividend income passively. We collect call income at high points, put income at low points. We reinvest the call option income, the put option income, and the dividends to buy more shares, which are effectively what we call our free shares now. Those free shares we rinse and repeat, and we'll do the exact same process again. And that's what we mean by generating income on income, which is interest on interest, which is exactly what compound interest is.
So that's the complicated part that people have to listen to very carefully.
Yes.
Because we're on audio for the podcast. The strategy of how you choose the shares. Now, I know that we use Value Line as the to check out the shares and see what whether we think they're worth looking at or not. Do you want to give us a little bit about Value Line and why we use that?
Yeah, so for the audio people, I'll talk about it, but for the visual people that are seeing this recording, I'll actually share it. So
Yeah,
I'm gonna ask permission to be able to share there.
yeah, I'll just let you share that now.
So what I'm going to do, folks, I'm going to take you to our membership website, which the reason why it looks a bit retro is this is the same website we've established in 1998. And it's very much a support mechanism for our members. And we have a series of tools that support our members. And one of the tools we have is ValueLine. Now, if you go ahead and do your due diligence and your research on valueline.com, you'll discover that they were formed in 1931, 2 years after the Wall Street crash of 1929. It was founded by an individual to give people independent information that they can rely upon and trust to make good, sound financial decisions in the stock market. And the granddaughter of the founder still owns and runs the company. She owns 60% of it. So they've been in business since 1931, which I guess is 95 years now. And they've a wider than white.
Just before you go into that, Owen, I was studying the guy that invented it.
Yes.
And just for our listeners, he was looking for a way to make money.
Yes.
And he came up with the idea of what do people want? They were having to search loads of places to get information, and he started this. And what are we looking at? We're only 5 years short of it going for 100 years. So if people got ideas of something that they think will benefit others, you never know, you might be around in 100 years' time still selling that service.
Yes, it's an amazing story, and the fact that his granddaughter still runs it and owns 60% of it is another great story. And he came from an ethical place in that a lot of people got in the Roaring Twenties in the US, a lot of unscrupulous brokers did what's called pump and dump, where they hyped up companies, meaning pump it up, and then they dumped it on unsuspecting shareholders. So if you study history, the reason why a lot of people lost a lot of money in the stock market in 1929 is because they were buying companies that had no substance behind them, and then when the pressure came on, those companies went out of business and people lost everything and they committed suicide, lost their houses, lost everything. And so this guy looked at the social impact of what happened and from almost from a genuine desire to stop that happening again, he said, I'm going to produce a service that will give people independent information. And to that end, Warren Buffett and Charlie Munger, who's passed away, Warren's business partner since 1965, uh, avidly use Value Line as a source of information, as does Carl Icahn, as does all the top investors in the world. So just to give an example of a company that, say, everybody might know something about, say, if we take a look at Tesla, for example, um, we can take a look at it. Now, what we love about this service is, and for those of you that can't see what we're showing you, we'll talk you through it. But Value Line, in their wisdom, look at all of the stock exchanges in the world and look at all the publicly traded companies, of which there are about 40,000, and they cherry pick and only do reports on the top 4%. So by definition, Value Line have already got rid of 96% of the, if you like, the companies that are not up to scratch. And so think of it in soccer terms. We're looking at the Premier League here, or La Liga. If you're from Spain, we're looking at the creme de la creme. So straight away, we've got a report that was not written by Elon Musk, because everybody knows Elon Musk is a fantastic guy, but he tends to overestimate what's possible. Everybody says whatever Elon tells you, divide in half and multiply the length of time it's going to take. So this is not produced by Elon Musk or any of his workers. This report is produced independently by a guy called Mario Ferrero. And Mario does not work for Tesla. He works independently for Value Line. There's about 85 different analysts that work independently for Value Line, and their job is to tell you what's wrong with the company, not what is right with it. So everything that's happened to the company from day one, right the way up to, or sorry, they tend to track 15-year history and a 5-year future. So everything's happened Tesla in terms of earnings. So Tesla turned profitable for the very first time in 2020. Up until then, it was always a loss-making company, and it's gone from 21 cents per share right the way up to currently 180 this year and $5 in the future. So you've got a 5-year history, sorry, a 15-year history and a 5-year future. And so they're telling you that they see Tesla trading somewhere between these trading ranges here in the next 3 to 5 years. So you've got data here taking you up to 2031. And Value Line have been making projections and predictions since for like 95 years. So their estimates are conservative but realistic. So you can see here straight away that it's not very attractive to buy Tesla because you're going to pay $378 per share and you're only going to make a profit of 180. So if you do the maths, if you take 378 here, which is the price of the shares, whenever this report was done back in May 8th, 2026, these reports are done independently every 3 months. But just to take a quick snapshot on the 8th of May, 378 is the price of the share divided by the profit per share, which is 180, means it's trading at 210 times earnings, which means it would take you 210 years to get your money back in terms of when you buy a business, the only way you can repay that initial investment in the business is the accumulation of profit. So it's going to take you 210 years. So straight away, it doesn't look that attractive. It's structurally fairly strong, though. It's got a debt of 9.2 billion, but it's worth $1.42 trillion. So it has a very low debt to equity. It has a very strong balance sheet, and it's got $69 billion of assets and only 34 liability. So for every $2 of assets, they've only $1 of liability. They are forecast to grow their sales at 5% a year for the next 3 to 5 years, but more importantly, grow their profit at 11%. So anything you need to know about the company is in one piece of paper. But straight away, at 210 times earnings, it makes it very unattractive. And to put that into perspective, if we were to take a look at the overall stock market, the Premier League is what's called the S&P 500. And if we were to take a look at the PE ratio of the S&P 500 going back 155 years, you can see here on the screen, for those of you that are seeing it, um, you can see here that it tends to, in the first 130 years of the 155-year history, it tends to trade between a PE ratio of 20, uh, highs of 20 and lows of 10. So you can see here, it was a great time to buy shares during the Boer War. It was a great time to buy shares after the Wall Street crash. Great time to buy shares in World War II, depression in the 50s, oil crisis in the 70s. So you get once a decade opportunities to get great value in the market, and then sometimes it was completely overvalued. So that's the 120-year history. And so if you take a look at the last 30 years, the low tends to be 15 times earnings and the high tends to be about 45 times earnings. So if you were to take a look at Tesla today on this scale of the average, where the average is a range of 15 times earnings to 45, and now you've got Tesla up here at 210, it just puts into perspective how completely overvalued Tesla is at the moment in terms of a value proposition. So what we do within the Investment Club network, and if you choose to join one of our investment clubs, you will see that we focus down here at the lower end of the scale between 10 and 15 P ratio. And so if we were to take a look at another company that
Before you go off there, Owen,
yeah,
you've taken the numbers off, sorry.
sorry.
But one of the things that I like from this is I teach cycles.
Yes,
When do we have the high? When do we have the low? When is the best time to buy? And that's exactly what you were talking about as well, because you're looking at the high and the low, the ratio, and that is equivalent to what I cover with clients, which is cycles.
yes,
We're
yes,
always trying to buy in the lower half. We never know when something's going to go to the bottom. We never know when it's going to go to the top. And so we try to get this middle range where we're accumulating as much as possible. And I think what you just showed there then demonstrated that really well.
yes. So I'm not going to show everybody the difference between Tesla being completely overvalued at trading at 200 times earnings and something similar. So this is a company called Energizer, and they're a bit like the Duracell of America, Duracell batteries. And so they produce batteries, which is a great business to be in because it's a repeat business. You know, batteries run out, you got to buy new batteries. So straight away, Tesla was not paying a dividend. Energizer pays just a 6.5% dividend, and their P ratio is 5 times earnings, meaning that you pay $18 to buy the shares. Well, that was the price back in June 12th. That's actually this week. So this week you can buy the shares at $18, and you're going to be getting um, 355 profit per share. So when you divide one by the other, you're only paying 5 times earnings. So a great company. Um, it's it's uh, it's got a very strong balance sheet. It's got almost 1.5 billion of assets, and there's only 632 of liability. So it's almost for every $3 of asset, $1 of liability. Um, so again, it's just comparing apples for apples, and as Karen rightly says, everything moves in cycles. There was a time when the share price was high, and the PE ratio would have been a lot less attractive. So you can see here back here that sometimes in the past you would have had to pay almost 20 times earnings, and now today you only have to pay 5 times earnings. So if you're patient, you can get some great value in the market. So it's all about being a clever shopper and going for the January bargains rather than the Christmas rush. So yes, as Karen said, step one, within the investment club community, we don't touch a share unless number one, it's got a value line report, and of which there's only 1,700 that has value line reports. And number two, it must be great value. So that's step one. Step two, then we will take a look at the graph to see where it's at in terms of its cyclical nature, as Karen just mentioned there. So if we take a look at a chart as a comparison, and I'm going to, again, for those of you that are on audio, we're looking at the graph of, we're going to compare Tesla, which we just looked at. Tesla is currently trading at, we take a look at a long-term graph, is currently trading at a relatively high point, around about 381. And if we're patient and wait, if we did want to buy Tesla, we should wait for the low points, which is going to be around about 250. And if we're patient, it will get there because you always get lows. So you'd lows here, lows here, lows here. So the great thing about a chart, as Karen says, it disciplines you to not buy at the highs of 500, to buy at the lows of 250. So you save yourself a lot of money. You get a 50% discount if you're patient. And so if we take a look at ENR, which is the Energizer company, we can see that it is already low. It's already at a low point. So it's very attractive down here at this particular price. It was as high as $50 recently and has come all the way down to $20. So we're buying low rather than buying high. And again, we look at chart patterns and we can see that it's at the bottom of 3 rows down as well. So that's the second step of your success in the stock market. Step 1, look at your value line report, make sure it's very strong financially. Step 2, look at the chart to make sure that it's very strong. To make sure that it's got a lot of upside potential. So it has a very strong, what we call reward to risk ratio, meaning that it's trading at 20, could go all the way back up to 50, which is a 150% increase. And there's nothing to suggest it wouldn't, because it is fundamentally sound. And then the third and final thing we do is we take a look at the options. And so this is, if you like, the secret sauce in what we do, in that we use the options to be able to effectively own the shares for free. Meaning if we spend $20 on Energizer as a company, how quickly could we get $20 back in the market? So let's go ahead and take a look at some live prices and I'll call them out to you. So right now, if we took a look at Energizer and we said, right, it's trading at $19.40 in the market. How about if we sold an option to get it put to us at, let's say in August, we want to get it put to us at 20. And you might say, well, hang on, that kind of doesn't make sense, because you could buy it at 1940 today, but yet you're actually telling the market, I tell you what, put it to me at 20 in the future. And you might say to yourself, it's trading at $19.40 today in the market. And yet you're telling me that I'm going to let them put it to me at 20 in August. That looks like it's more expensive, doesn't it? It looks like, $20 is 60 cents more expensive than 1940, which is trading today. But if you look at the bid up here, the bid is 2 and 5 cents. The ask is $2.25. So let's be conservative. Let's say we collect $2 up front. So to spend 20 in the future, we're collecting $2 up front today. So if you actually look at your effective cost of that share, it's going to cost you $18 to get it put to you. So $18 is a lot cheaper than the 1940 is trading at today. So that's what I mean, Karen, by using put option premiums to get shares put to you at a discounted price. So you start out live straight away, it was put to you 20, but it only cost you 18. And so you've already collected 10% up front in terms of.
And that takes you back to what you were saying with Warren Buffett, where he said you get paid up front at the start, because
Yes.
that's exactly what this strategy does.
It pays you the money up front, exactly. And then let's imagine you've already got it put to you, already own it, and you want to do the opposite. You want to sell a call option and get it called away from you. You can see here already they're offering us somewhere between 145 and 210. So let's say conservatively we're going to collect 150 to get it called away from you. So you got paid +2 to buy it at 20. And now if you turn around and told the market, I want to sell it back to you 20, you get plus 1.5. So between the $2 put premium and the 150 call premium, you're collecting $3.50 already, which effectively is like 17%. So you can see very quickly in a relatively short period of time, if you spend $20 today in the market, between the combination of D for dividends, P for put options, and C for call options, there's no reason why within 2 to 3 years you get $20 back. And the beauty about that is you completely de-risk the underlying asset. You paid $20 for a house and you got $20 back in rent. Now the house is free and everything you do thereafter is pure positive cash flow. So in summary, to be successful in the market, look at 3 things. 1, look at the value line report to make sure you've got a very strong company. 2, look at the chart to make sure it's at a low point. And 3, make sure you get paid up front to buy it. And then once you own it, make sure you continue to cash flow it, that you end up eventually owning it for free.
So the thing I like about this, Owen, I'm very much a systems person. And when you run a system, it takes a lot of the decision making out. As long as you're following the system, you know, it's doing this, I buy. And like you said, you check in value line, do the numbers stack up at value line? You check in the chart. Was it at a low? Yes. I'm in the opportunity to buy, and then you're getting paid up front. So when you've got that system, it takes a lot of that decision making away from people, and they know I follow step one, two, and three, and I make some money.
Yes.
And for me, I come back to what I said at the beginning when I was going to talk about how I started with you, because my clients, I had quite a few clients who wanted to learn to trade. And for them, if they're not trading means that that was the only aspect that they actually saw. And I teach dividend investing, which is sit back, wait, and take your money, and the income starts coming in. But this offers a way of a hybrid to trading, but you've got a system behind it.
Yeah, it's a combination of long-term buy and hold, which is like classic Warren Buffett value investing, along with short-term income generation. So you're getting the best of both worlds. You're in it for long term,
Mm.
but you're actively collecting money every month. And for me, it allowed me to live off the market. After 2 years of doing this, I no longer need my salary from my day job, so I could live off the income. And so that's the opportunity we're offering everybody that's listening to this podcast. You can join an investment club, dip your toe in the water, learn how the system works, and eventually you get to a stage where you've built up enough of what they call a critical mass of income producing units, i.e., shares, that now you can start to pay yourself a dividend. So I see this very much as spend 5 years building a foundation and the next 5 years paying yourself an income.
And we're talking 10 years or more.
Yes. Yeah.
And generally, anything that you do is a long-term investment.
Yes.
There's
Yeah.
there's no way about it.
Mm.
But you can, like you said, you can generate income upfront,
Yes.
right? And you can reinvest, or you can take. I use a strategy in shares where I reinvest 70% of what I make and I draw down. Well, I reinvest 75, I draw down 25%.
Yes. Very clever.
So I'm generating income every month from my dividends, but I'm also reinvesting. So my pot goes up every month.
Yes.
And that way, I feel like I give myself a pay rise every month because my dividends go up as
Yes.
well.
Yes. Yes.
So I'm on a constant getting paid extra every month, which I like, which is why I like dividend investing. But again, there are different strategies you can use so that you can make money and still continue to grow the pots that you've got there.
You can, and I have a number of clients that are with me for more than 5 years, and they're in like year six, year seven, year eight now, and they've collected so much income. They've now started to pay themselves, and now I have a number of clients that have paid themselves more than they put in. So
Mm.
now it's what everything that's there is pure. It's the market's money now. They've whatever they invested, they've got back, and now they're operating on free money now.
And I want to come back now to the cycles.
Mm,
Like I said, I'm systems, I like cycles and things
yes.
like that. Um, when you determine on a put or a call, are you always looking at the low or are you looking high lows for either a put or a call? Just
So
clarify that a bit more
yeah,
for
so
listeners.
if you're starting out brand new, Karen, if you've got a brand new account, and let's say you put in 100,000 and you've got no shares, you're selling puts with the view you do want them to be put to you because you need them to get the dividend, you need them to get the call. So in the beginning, you're relatively aggressive in that you're saying, I want you to put it to me. So you're basically, if the share is trading at 18, you're doing like a $20 put, and the odds of it being put to you are high. Once you've got enough of shares and you say, well, now I'm selling puts not necessarily to accumulate shares, I'm selling puts now just to make money. Because remember, if the share goes up, nothing gets put to you, you just still get to keep the cash. So then you get more conservative or neutral. You say, well, I'm selling this put kind of care. I don't care if it put to me. I don't care if it is. And then after a while, you're saying, no, I'm just selling puts to make money. So then you'll switch to be more conservative. It's trading at 20, you're selling maybe a 17.50 put, and the odds of it being put to you are a lot less. So depends on what stage you're at in the cycle. Phase one is to sell puts solely to get shares put to you. Phase two is to allow them to be put to you. Phase three is now that you own shares, start to collect call income, start to collect dividend income. And phase four is now selling puts for a different reason, just to make money.
Now, going back to the clubs,
Hmm.
people can put in whatever they want.
Yes.
Now, I know with my clubs that we have one club that puts 50 a month in, the members put 50 pound a month in. We have other clubs where they put 100 a month in, or we have one that people put even larger, put really large sums in.
Hmm.
There is a flexibility that we have within those investment clubs.
Yes.
That often when someone's doing shares, I hear all the time, you need at least 10,000 to get started in shares.
Hmm.
But what we're doing with the investment clubs is showing that you can start and you can start small.
Yes.
So I just want to get that message out there that you don't need 10,000 to start. What
Yes.
we do is the idea of the investment clubs is we can bring people together and they enjoy that
Yes.
benefit of working together.
Yes. So what I'm showing for those of people that can see the visual, I'm actually showing a club that Karen and I started back in February 2022, and it started very modestly with I think the first guy put in something like it looks like $800 we started with here. And so from a start with just one member at $800 or a number of members with $800, we've now grown that account to if we go, we're now up to about almost 2.5 million.
Yeah.
And so the point that Karen is making is that if you rang up a traditional broker and said, I can only afford 100 a month, they would not do business with you. They would say a minimum of, say 5 or 10 grand or whatever. The beauty about it being part of a community, being part of an investment club is like a safe, supportive environment where you can put in your £100 a month or £200 a month or whatever you can afford to invest, and you're part of a much bigger project. So your money's been you're leveraging other people's money and other people's time. Within this club, we do have people that are, can barely afford the 100 a month, and yet they're participating from being part of a $2.5 million project.
And the other thing with this is everybody gets the opportunity to learn.
Yes,
But we haven't got one person who's out there doing everything in the club. The idea of it is that we repeat the system every meeting and then everybody gets to learn.
yes,
And that to me is really important because it's the knowledge and the learning, and then you can contribute more to it if you want to, and then you help your club grow even more.
yes. And there's a career path within the community because you can start out knowing absolutely nothing, just join a club with £100 a month, get a bit of knowledge under your belt, start to say, well, this is interesting, maybe I want to learn myself, and you can start to become someone in the club that holds a position like a trader, a treasurer, secretary, chairperson, etc. But within TICN, we have a lot of private clients that come to us and want us to provide a service, and we need to build teams to service those clients, and we're happy to share the success with those people that get trained up. So you can start out know nothing, hold a position in the club, eventually learn how to trade yourself, and then eventually be one of our trading teams.
Yeah, so it's not just put your money in, forget about it. It's everything that we do is all based on the education.
That being said, there are some people that are quite happy to put the money in and just be passengers on the bus, which is fine as well, because without their money, we don't have a project.
Mm. So we're running out of time, and I got a
Yes.
lot more, so we may have to do a second session. But if people want to join, I know for my clients or people that follow me on various platforms, they can just get in contact with me, or they can go direct to you, Owen. And how do they get in contact with you?
Yeah, but anybody obviously that hears about this, we would want to link them to you. And Karen is in the great position. She's got small, medium, and large. She's got a small club you could join. She's got a medium-sized club you can join, and she's got a large club you can join. So she can cater for small, medium, large. So anybody listening to this recording, go directly to Karen, and Karen can make the arrangements. If you want a private one-to-one Zoom with me or Karen, that can be arranged as well. So we can see how much you've got, what your plans are, and find the right club for you. But definitely, Karen can cover anybody that's listening to this call.
Great. Thank you for that.
You're very welcome.
It's been interesting, and I hope for our podcasters it's not too confusing, the numbers. There are a lot of numbers we've gone through today, but it's based really all on the strategy and the system that's there.
Yes.
And for those who are watching the charts, go and have another look at them, have a look and see what we do, and come back if you've got any questions, and we're happy to help you out with those.
And just to leave everybody with this comment, that I've been doing this for 30 years, Karen, and I know in my heart and soul that everybody can learn this, that it is teachable, and you just need to be patient, and eventually you will be very surprised at how much you will learn over time.
And the interesting thing is, I know our groups, I know my groups, and we've got people who are late teens, early 20s in the group, to people who are actually up in their, I think, 75 to 80, and they're participating in the clubs and they're part of everything. So, it doesn't matter what your age is, you're never too young or too old to learn about investing.
100%. Very
So,
good.
Owen, I'd like to thank you for your time this evening. I know for me, I enjoy it. I hope our listeners have, and maybe we come back again and go into it a little bit more, go more into the systems and stuff a little bit more.
Yeah, and I want to thank you personally for all the work you've done behind the scenes with the three clubs you've done with us. And it's not been easy for you, Karen. You've gone through some health challenges and some other challenges with COVID and stuff. So I really admire your tenacity and your desire to serve people and help people. So you've had to overcome a lot of challenges in 6 years. So thank you so much for sticking with us.
I've enjoyed, well, I have literally enjoyed it. It's numbers, and like you said, the same as you, it's all about helping other people. We
100%.
we all have the ambition that we've made our money, we know how to make it, and we just like to let everybody else enjoy
100%.
build it. So
Yeah,
thank you as well, Owen.
you're very welcome.
Disclaimer: the information shared in this podcast is for educational and informational purposes only. It is not intended as financial, investment, legal, or tax advice and should not be construed as such. I am not a licensed financial advisor, and the strategies discussed are based on personal experience and general market knowledge. Always do your own research and consider your individual financial goals, risk tolerance, and personal circumstances before making any investment decisions. I strongly recommend that you consult with a qualified financial advisor or licensed professional before acting on any information discussed in this podcast. Investing involves risk, and past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated entities are not responsible for any losses or damages arising from the use of this content.